It's been a week of twists and turns for Indian markets. Volatility is back and markets are now falling more and rising less. Next week it's going to be down to the wires. We've got corporate numbers and Coal India IPO. We'll discuss implications of that with a very special guest, but before I introduce him, a profile of him.
Parag Parikh is a man who sticks to his guns, like in 1998 and 2000 when he sensed the IT bubble and sat on cash. He initially lost money but came out of it saying, "I told you so." His experience spans over 3 decades. He started off as a stockbroker in 1979 and was one of the first to offer portfolio management services with an annual return of close to 24%. Parag is a student of behavioral finance. He believes timing the market is impossible. You can only time your purchases.
Parag, welcome to Market
Thank you.
Thank you for joining us.
Thanks.
Parag, 20,000 on the ticker, 6,000 plus on the Nifty. Are these levels sustainable? Because for the week gone by, markets now are consolidating. It's no longer a vertical gain what we experienced in the month of September.
That you are saying because in last 2 days the markets have been going down. So this is typical of the markets that when the markets are going up, people start predicting 22, 24. When they start going down, they start okay with 18, 16. So I think it's too early to predict that the markets are just going to go down. Of course, as I've been always maintaining, BSE Sensex is made up of 30 stocks, Nifty of only 50 stocks. So we are looking at a very small sample size to judge the markets. And there is a whole lot of more than 6,000 stocks in the market. A lot of values emerge over there rather than this.
So there is margin of safety in this market.
Well, margin of safety is only when you are buying or doing bottom-up stock picking. There will be a lot of stocks which would be neglected sectors, and you can definitely even buy good values at an index of 21,000 or even 25,000.
We'll talk about some of the specific names and themes, but a word on Q2 numbers and next week Q2 numbers and Coal India IPO. These are two events which could be a game changer for Indian markets.
Well, Coal India IPO would definitely be a game changer because I'm very happy. I never believe IPOs because they are always overpriced. The merchant bankers are greedy, but this Coal India, we have our government who are really concerned that the investors cannot be butchered, and we have seen what has happened in the midst of big bull markets. Private guys, they just come and take people's money and the stock prices go down. And if people make money in Coal India and if the sentiment stays intact, because it's important that the sentiment stays intact. So it's a chicken before the egg and egg before the chicken. If people make money, the sentiment will be good. At that time, we have got a whole lot of real estate issues coming in, and if people start losing money over there, then you could have some sort of sentiment break. But Coal India, I'm very happy that it's been so fairly priced. There's money on the table for the investors, but investors got to realize that investment is a long-term game. You just buy and then go and sell on listing. That should not be the criteria. You can use that criteria with all other stocks where you are only looking at trading, but not something like Coal India where the government has been very fair to the investors.
So for retail investors watching the show, your verdict on Coal India is that they should subscribe?
Yeah, they should definitely subscribe for Coal India.
Subscribe and then hold on.
Yes, hold on. I think that is because let the traders, let the punters, play their game for the first 3-4 months. They'll buy, sell, buy, sell, buy, sell. During those times, if the stock price goes down, you will have an opportunity to buy also.
Coal India is a commodity stock, and I know you don't invest in commodity stocks. What is so different here?
One is it's been very fairly priced. I don't invest in commodity stock. As a business, we don't like it. But any business which is fairly priced is something people can go. Secondly, who am I to say that Coal India is such a big issue which is coming and don't invest for it? They say it's not common sense or to talk. So you don't invest just because I don't like commodities.
What about market valuations, Parag? At these levels, markets are trading at P multiples of 15, 16 times, 17, 18 times, depending on the estimates you track. Do you think we still have a long way to go? Because historically, every time when Indian markets have peaked out, valuations have been crazy. P multiples have gone beyond 25 times, they've gone beyond 30 times. So if I use history as the benchmark here, we have a lot of room to go. See, first is we cannot only judge stocks by only P's.
Because what if the profitability is going to come? I'll give you an example. During the bear market of 2008-9, the Emphasis, which was beaten down to as low as 130 rupees, and the quarterly results were always growing. However, the sentiment was so bad that the stock was not moving up. Similarly, over here what happens is, if the profits are growing and if the stock prices are going, then I think that we should not be scared. But then we also cannot assume that every quarter to quarter is going to go up. There are going to be breaks. You can't be having something which is going on just one way. But the market has become such that even a 2% drop in the profits, people go and dump the stocks because analysts come out with sell reports and all. Now, when such stupidity is going in the markets, a good value investor is going to look at, well, you are giving me an opportunity to buy. And investors got to be understanding that you got to be seeing sustainable earnings of a company rather than one up or one down.
Let's look at some names. Your number one investment idea for our viewers.
Yeah, my number one is today Noida Toll Bridge. I personally don't like infrastructure stocks.
This one is different?
This one is very different, because infrastructure stocks, they require huge amount of capital. So most of the time they come and they have got a long gestation period. Plus you have always cost overruns and all those things. People are getting into building airports, this, that and all. Then when you enter the airport, they have got such cost overruns that then they the people who enter this thing, they pay charges to enter because of the cost overruns. And infrastructure companies, they are highly debted, so the interest factor, so they are actually earning money for the creditors. Now this is a company which is very unique. It came out with a convertible debenture issue somewhere way back in 1997, and like any other infrastructure company, they had rosy pictures, this will happen, then the project had cost overruns, everything. That's why it's got a bad name. Now that's a bad thing has happened to a good company, and now all that is past, because this came when the interest rates were about 20%. So all that debt restructuring, everything has happened. Company has taken about more than 10 years to go through the process. Everything is in place, and now the company has started making profits, and they have declared a dividend also. So
what's your price target for Noida Toll Bridge?
See, I never would like to give a price target, because price target is just making people happy. But I think it's a great investment, because now all the problems of the past are over. Someone is sitting over there, cars go this left or right, you get your toll, and then it requires a minimum amount of I would say upkeep, and now is where the profits are going to come, and investors are just selling. And how do we know that the company is really making profits? Only when it gives a dividend.
And they have given a dividend.
They have given a dividend, now 50 paisa per share.
So a good business available at a bad price.
At a bad price.
That is the perfect time to buy the stock.
Yes. If investors are buying stocks on infrastructure, paying such fancy prices, why not this stock?
The challenge for Noida Toll Bridge, Parag, is that the asset which they own is only one asset, and beyond that asset they really don't have any other business avenues, which could be a restriction.
It's a restriction, because don't you believe in core competencies, that suppose if this is an asset. Secondly, I forgot to mention this earlier, that they had a 30-year lease to collect the contract, but the way the terms were situated and way they have not been able to make profits, I think this will go up to 60 to 70 years also. And they have also got certain land which they can develop.
It's a virtual monopoly.
Yeah, so it's a virtual monopoly, and are we concerned with they making money for us, or are we concerned that, like some other industrialists in our country, go into every piece of business or action which is there? It's whom you choose,
Fair point. Buy businesses which are focused. Parag,
Yes.
stay with us. Let's take our first break on Markets Mantra. When we come back, much more specific chat and much more stock specific chat with Parag Parikh. Welcome back. You're watching Markets Mantra on ET Now, and we are in conversation with Mr. Parag Parikh. Parag, you identified one stock for our viewers, Noida Toll Bridge. Let's get one more idea.
Well, this idea is based on a different concept. Since every day the newspapers, everyone talks about India doing great, India's figures are very good, the stock markets in India are doing great, and the world over there is a recession, and we take pride that things in India are very good. I'm also happy being an Indian. But if I'm looking at good investment opportunities, why did people make money or are making money today? Because they bought 2 years back when the markets were down and out. Now today, if you really want to make money in the future, would you be putting your money only in India or somewhere where you are getting valuations 1/3 the cost of what is in India?
So look outside India,
Yeah, definitely look outside India.
even if you're buying equities.
Yes, even if you're buying equities. I'll tell you. I'll give you an example.
How does it work?
Yeah, I'll give you an example of a very good share. Standard Chartered Bank. Now tomorrow, today what is the fancy in the markets is
Buy Indian banks.
buy Indian banks, Indian PSUs. Very good, very good. I would say that Standard Chartered Bank, which is listed in the London stock markets, you know, all UK, US, all markets are really down and out. So today most of the companies which are listed in such markets, although if they are doing good also, they think you are getting a chance to get them at very good valuations.
So buy Standard Chartered, which is listed in London.
No. You can either buy it which is listed over there, or you buy they're saying Indian Depository Receipts which are listed over here. It's quoting at around 118, 19 times, rupees, and it's available at 1.6 book value. And you compare that with HDFC, you are paying HDFC 5 times book value when you are buying an HDFC
What
stock.
about the basic growth? Now for banking businesses to grow, you need credit offtake. For Standard Chartered, India is growing, but the other markets, the credit offtake is not there. So if you're buying a global company, yes, there is a bit of pessimism, but what about business growth?
No, see, I'll tell you, first is today in a globalized world, you have to look at companies, even they are listed somewhere else, they're saying, where is the business coming from? Standard Chartered Bank, I think 21% of its business is coming from India and the emerging markets. A lot of things are happening over here. So the company is growing over here also. And if you see most of the M&A deals and all, we always read about Standard Chartered Bank. They've got money, they've got good muscle power. Now these are globalized banks. And I think a very low percentage comes from the developed markets like the US and UK. It's all from the emerging markets.
So the global risk is not very high.
No, not at all. Only thing you are getting, you look at it not as risk, as an opportunity because it's listed in the London stock markets.
What about local banks? And let's categorize them into two, PSU banks and private banks. The run-up has been strong. The banking index in last 1 quarter is up about 30%. At these levels, are they fairly priced?
Yes, definitely. I won't be buying those banks at these rates, at this age. They are fairly priced. They may go up, that's a different thing. But today if I'm making an investment decision, then I'm looking at buying a value. And I see a great value in an idea of Standard Chartered Bank.
Are you fully invested in the portfolios you manage?
No. We are sitting on cash till we get certain opportunities like this, Standard Chartered, Noida, this thing. That is the time we buy. Of course, Noida we bought it long back also. So just now we are pretty in cash. I would say we are scared to be in the Indian markets, and we only buy when then an opportunity comes. And these opportunities, they will come at every index rate.
Are you booking profits also selectively?
Yeah, selectively we are booking profits.
So which are the themes which you think markets are now mispricing growth?
One is we look at the companies, they think what are the P's. I suppose if you ask me HDFC Bank or not, well, it's very expensive. So I would definitely...
Even though the business is growing?
Let the business grow, but if it's not only business is growing. If I don't have any other opportunities, I will be with the business where it is growing. But if I am getting certain opportunities, then I'll definitely go. And secondly, it's not at all painful to be in cash. In 2007, we were in cash for over an extended period about 1 year, and then when the opportunities come, it takes care of all the opportunities which you have lost in 2007. So I think it's a wrong misnomer in everyone's mind that being in cash you miss out on the opportunities, because stock market offers opportunities at every rise or every fall.